Hey you guys, so we are here to bust the myth today on term life versus whole life, right? Term life versus whole life. I wish I had like a let's get ready to rumble, right? I don't know, that's for all my boxing fans, right? My son is over there. We like boxing. So we hear this all the time, or ever heard it, right? In the insurance industry, buy term and invest the difference. Even if you're not in the insurance industry, you've heard that before, right? Buy term and invest the difference. And so we want to bust that myth on today because I get a lot of people as I meet with insurance clients, as I'm meeting with home buying clients. Oh, who am I? I'm Garlinda Price. I own Fusion Properties LLC and I own Fusion Insurance Group. And so I'm a licensed real estate broker and a licensed life insurance broker. The difference is, as a broker, I can own my own firm. I work for myself versus an agent that works for a firm. So I know in a lot of states you'll hear those terms kind of interchangeably. And I've had people say, no, you're an agent. I'm like, no, I'm a broker, right? So everybody in North Carolina that sells real estate is a broker. For life insurance, I'm a broker and I'm a non-captive agent. And what that means is I can represent any carrier that I choose to represent, and I can do business for my client because I'm non-captive. That means that I have multiple products that I can help my clients invest in, purchase in, whether that be funeral and burial insurance, whether that be whole life, term life, universal life, whether it be annuities, you name it, children's policies, accidental. I also have a health license, so I can do dental, vision, and accidental policies for people up to age 75. So I can do the gamut. That means I work for you, and I love that. That's why I'm an independent, non-captive broker. So term life versus whole life, we get it all the time, and a lot of people will reach out to me and say, I want $1 million policy, and they're 55 years old. It sounds like a doable thing, right? It sounds like they should be able to do that, but no, they can't, right? The average term product ends at age 53. So that means that if you're not 53 years old with a term policy, you're not going to be able to get a term policy, right? So when people say buy term and invest the difference, right, they're not even always thinking about, well, if that person's over 53 years old, they're not even eligible to purchase a term product. That's number one, myth busted. Number two, in order to buy term and invest the difference, you've got to be healthy, right? And so the average person that's over, I would say 40 or 45, is on some type of medication sometimes, right? Not everybody, but a lot of people over the age of 40 are on medication. Some people in their 30s I've met are on high blood pressure medications, diabetic medications. So depending on the medications you're on, you may not qualify for a term policy or a term product. Why? Because that medication and what it's being taken for is a kick out. Even if you say, and I hear this all the time, even if you say, but I never took it. It was prescribed to me, but I didn't take it. The doctor said I had this, but I didn't take the medicine for it. And then they found out I didn't have it, so I didn't take the medication. But the medication that was prescribed to you was put on something called the MIB report, which is the Medical Information Bureau, right? It's a nonprofit organization that gives information to all the insurance carriers on our medical and prescription history. So when I go to the doctor, or I've gone to the doctor in the past, and they're like, oh, we want to give you this painkiller. No, I don't want that. You're not getting ready to prescribe that to me. Don't even put it on my chart, especially an oxy product, right? Because why? It's a narcotic. So when you hear someone say buy term and invest the difference, you need to make sure and ask them, well, does that pertain to me and does that qualify for me based on my age, based on my health, based on medications, based on my circumstances? Is that the best policy for me? Myth busted. The third thing about a buy term invest the difference, or a term policy in general, when you're over a certain age, is they are very expensive. When you're young, they're super inexpensive, right? So if you're 18 years to, I would say, 30 to 35, a term policy is super inexpensive for the most part, especially for the higher values like 200, 300, 400, 500,000, $1 million policy. They're pretty inexpensive. But once you hit that 40-year-old mark and you want to purchase a term policy, you're talking about anywhere from $140 a month in a premium payment upwards, I've seen them as high as $800 a month, right? So not only that, so myth busted. Everybody can't buy term and invest the difference. The fourth thing about it, and I'm not saying these aren't good products, you got to know where you are in your goals for you and your family, in your age and your health, and then what are you getting the insurance for? What is it that you want it to do? So term products are normally purchased when someone's in their younger earning years, and they need something to take care of their mortgage payment in the event they were to pass away, right? So normally a term product is purchased at that large of an amount to pay off a house, to pay off a mortgage, to be able to keep the bills being paid and the cars being paid, daycare, college, all those things in the event of the death of the breadwinner, or in the inability of the breadwinner to continue working if they have any type of terminal illness riders, chronic illness riders, or it's terminal, chronic, and critical illness. If they have any of those type riders on their term product, then that's what that's for, is to pay those bills and cover those expenses. Okay, so the other thing about a term policy is it's going to end. It has a term, right? So that's what it means. From the date you got it to the date it ends, the term is going to go away. It's not if it will go away, it's when it will go away, right? So that means that you invest in the term product, which is not a bad thing, but you just have to know that at the end of that term, if you don't have permanent insurance or a whole life, something that will cover you for your entire life, you now are uninsured. And a lot of times term products end or run out when someone is older in life. Now insurance is more expensive. Now their health has changed. And so now they may not qualify, because you can't buy insurance. It's funny when we meet with people, and when we're calling leads, or we may be talking to our cold market, and they're like, oh, I'm not interested in buying insurance. I tell them really quickly, well, you can't buy insurance. You have to qualify for insurance. Your health qualifies you for insurance, and you pay for it with your money, right? So you can't just go buy insurance, right? You have to qualify. Unless you're buying an accidental only policy, I'm going to write myself a note to educate you all about that on another day. Okay, so that's a term product. So don't buy into the myth about buy term, invest the difference. And then the last thing I want to share about a term product is tied to index universal life, right? So you'll hear people talking about private banking and IULs and how phenomenal and incredible they are, which they are, but there's three things you got to be concerned with, and maybe a little bit more than that, but the three I'm going to touch on that you want to be cautious about, and you want to talk to your professional insurance broker about when you're looking at an index universal life, is there's an insurance component to it, right? So the insurance component to the index universal life is a term life product. So that means that you got to qualify with your health for an index universal life product. If you're not in great health, you don't qualify. Right? So whenever someone's trying to talk to you about private banking, and that being really the only way they say that you can get private banking, it's not true. You can get that through a whole life product, which I'll educate you on in a second. But you have to be able to qualify with your life in your current health status for the term life derivative of that index universal life product, or component, I should say. So everyone's not going to qualify for an IUL for private banking because of their health, because of their medications. The medications can kick you out. And I'll give you a good example of one of the medications that tends to kick people out of qualification for term products is gabapentin, right? So even though gabapentin may be used for one thing, and your doctor may have prescribed it to you for this reasoning, because it can also treat neuropathy, right? And that's a kick out question for a lot of carriers if someone has had neuropathy, because now they're thinking, oh, this person doesn't have great circulation. They're thinking this person has nerve damage. They're thinking that this person is a potential future amputee, right? This is the mindset of the insurance company. So therefore, in them thinking that way, they're not going to want to insure you for a term life product because of that medication, right? That's just one example. If somebody has COPD, you can still get coverage and first aid coverage with a lot of companies for COPD, but it's a kick out question for some people. Organ transplants, haven't had cancer prior. So with all those things, and that's why you want to talk to a professional, we know these things. And as a broker, we can shop around for you and see, okay, who doesn't care that they're on dialysis that will still get them the insurance coverage that they need to protect them and their family. but it's not going to be a term product. So term timelines are going to be, you can get a term for 10 years, 15 years, 20 years, 25 years, okay, 30 years. So the max is 30 years. But again, you have to qualify with your health. So let's say that you're over the age of 40. So when COVID happened, right? And I feel like now we're post-COVID, even though it's still a thing in some areas, we're post-COVID for the, just for today's purposes, right? Post-COVID, the insurance carriers moved whole life down to age 40. So before, you had to be 45 in order to qualify for a whole life product, right? So you could be a child and get a children's whole life policy up to age 17, but then you couldn't get a whole life policy or a whole life product if you were under 40, right? There's some companies that do whole life even younger, right? They're a little bit more expensive the younger you are, only because they're going to go with you for your whole life to age 120. Some companies age 100, some companies age 90, right? But it is a whole life product, and we can pick who can help you find the one best for you, help you pick the one that fits your budget. We can accommodate every budget, right? So you just may not get as much as you want, but some coverage is better than no coverage, right? It's so funny to me when people say, oh, $20,000, that's not a lot. $40,000, that's not a lot. So I do the math for people. $40,000 divided by 12 is $3,333 a month. That is a lot to someone that lost a family member that now is responsible for making the mortgage payment, the car payment, the daycare payment, the lights, the electricity, food on the table. $3,333 a month is more than some people make in a month. They're going to get that money every month for a year, or a flat lump sum of $40,000. It will buy them options, right? Guess what else a $40,000 whole life policy, a $20,000 whole life policy will do? It will give them the opportunity to grieve without worrying about where the money is coming from, right? That's the second thing it does. The third thing that it does is, what if they can't afford to stay in the house because the mortgage payment is more than what they can qualify for? They can keep the house, put a tenant in the house. Now they have an investment property, and they can go get something they can afford. Even if it's a rental, so what? They still own their home. They could then refinance that home, right? If they have the credit and they have the money, they could refinance the home into their name if it's possible for them, get the mortgage in their name, and they keep the home. Or they could refinance the home, do a cash out refinance, take the money out of the house, go buy or rent them something else for cash, right? Or for an amount they can afford. Now they still own that home. The tenant is paying the bill, the tenant is paying the mortgage, and they're still over here financially and fiscally sound because someone thought enough of them and loved them enough to put whole life and insurance in place for them. It matters, and every amount matters, okay? So I don't want you thinking, oh, that's such a small, it's not. It's a huge amount when the person's not here, okay? It's an act of love. So whole life compared to term life, like I said a second ago, is whole life will go with you your entire life up until age 120 most of the time. You can buy a whole life product starting at different ages, but I'll just say one company in particular that I can think of off the top of my mind. You can buy their policy for whole life as young as 40 years old, right? Another company that we work with that has funeral expense, and they have this incredible funeral advantage program that I'm going to talk to you about in a separate video. You can get insurance with them even up to age 85, right? So that means at 85 years old, you can go buy insurance, where most carriers, you can't buy insurance if you're older than 83. So we have access to all those things we can talk to you about. So with whole life, there's 5 things to think of. 1, it goes with you your whole life. 2, the older you are, the less expensive it is. Different from whole life. Different from term life. The third thing is you can borrow against the policy. Now, it does take about 5 to 7 years for any significant money to be in the account because it has to build up. And just like a mortgage payment, the first few years you're paying the premium, right? Or you're paying to build up the account. But you can borrow against the whole life policy, and you're your own bank. So when you hear people talking about private banking and how they're using insurance to be their own bank, that's what they're talking about. Once enough money is in that whole life policy or in that whole life product, you can borrow against it. Now, it does decrease from your face value if you die and the loan that you borrowed from yourself, the money isn't paid back. But you're borrowing at a lower interest rate than you would from the bank. You're using your own money, so you don't have to qualify with credit. That's incredible, right? You can take the money out of the face value of the policy for any reason without having to explain it to anybody why you're using it, right? Whereas with a 401k, there's limitations. And with some of these policies of what you can take your money out for, like a mutual fund and 401k, I'm just knowing some of the examples, right? Is if you were going to buy your first home, or if you were going to pay for a college education. Right? But let's say you want to take money out of your insurance policy to go on vacation. You could do that. Let's say you want to take money out of your insurance policy to buy a car. You could do that. And you're borrowing at an interest rate like 5%, which is lower than the bank, and you're paying yourself back. Right? And it could potentially be a tax write-off. You'd have to ask your tax professional. So that's the third benefit of a whole life product. You can borrow against it. You can be your own bank. The fourth one is if it's a children's whole life, it doubles when they turn age 21. The fifth value is the premiums are never going to change, regardless of if your health changes. With most companies, some carriers are different. If your health changes, you still have that policy. The payment stays the same. The face value stays the same. And guess what? If you're with one company that I know of, if you have a policy with them of this type, you're guaranteed insurability if you want to add another policy of a different type. Really great program. So a whole life product also is great in the event that it has two values that are really awesome. So let's say that somebody dies, I say value, but value based. It's a value based product, right? So two things that are really awesome about a whole life product. Not every carrier is the same, but just two of the carriers that are my favorites that I can think of off the top of my head. Is that, let's say you have a whole life policy of $40,000 and you die naturally, right? You die of natural causes, you die of sickness, you die of illness, you die in your sleep, right? You have a heart attack, whatever the reason for death is, it's of natural causes, not an accident. Then you get $40,000. Your beneficiary will receive $40,000 in a lump sum, or they can choose to opt to have it as monthly payments. But let's say, God forbid, you die in an accident. Right? You die in an accident, in a car accident, an Uber accident, a train accident, a bus accident, a plane accident, a vacation accident. You're on a cruise ship, the cruise ship sinks. You know, these things sound morbid, but I'm giving you an example. Somebody pushes you down the stairs, you fall down the stairs. It was an accident. It was something that was beyond your control and not at your fault. Right? Not your fault. Then that $40,000 whole life policy, if it's been set up properly by your broker, doubles in the event of an accident. So now not only do you have $40,000, it doubles to $80,000 in the event of your death, and you're still paying the premium you were initially paying in the event you had bought it for $40,000. So you get double the benefit for the policy. So when people say $40,000 isn't enough, if you bought the right policy and that person dies in an accident, you just really got $80,000 value, but you were only paying for a $40,000 policy. Come on now. It makes sense, right? And so it's our responsibility to protect our families, to protect our children, to protect our investments. And let's say you already have insurance, right? Because we hear people say this all the time. 3 things. I want to write it down right quick so I don't forget. People will tell me they have insurance on their job. Okay, if and when you leave your job, you don't have insurance, right? And even if you are able to take that insurance with you, when you leave your job, it becomes a convertible product, convertible term. So that means that you have, convertible or renewable term. It doesn't convert to a whole life product. And if it does, it's no longer at the group rate. So it's going to be more expensive than what you were already paying. Okay, so you need your own individual independent policy that you pay for on your own, and you can start out at a small amount and grow it from there as your income increases. Do not just be dependent on a work policy. I was doing a ride along with one of my mentors here in the insurance industry because I'm new to one of the carriers, and so they were like, hey, you can go ride with this experienced broker, see how she does business. And it was really cool because the person said they had, she was telling me about her story, about her testimony, how she got into insurance. She was in her 27th year of work and had 3 years to go before she was vested in her company and before she could retire. And they did away with and eliminated her entire department. When they eliminated her entire department, yes, they gave her a severance package, but she no longer had her life insurance, right, and her health insurance for the group rate. It went to whatever they offered her outside of that company, and it was expensive, right? And now it's 27 years later. She can't get it at the same price she got it for when she was 27 years younger. So now it's more expensive, and she didn't have a job, right? So you don't want life to catch you like that, because a lot of times corporations are not loyal, and now you've left your family unprotected, right? Then I have a lot of people tell me, oh, the military is going to bury me. The government is going to bury me. Well, I want to say thank you to all the service members and their spouses and their children for the sacrifice that you make for our country. I'm the daughter of a Marine. I love my dad, Semper Fi. And so the military does not pay for burial. What they would give is to a veteran is $735. And what they would give to the living spouse and any minor and dependent children at the death of the veteran is $250. That's it. They don't pay for a funeral, and funeral costs are anywhere now from $7,000 on the low side as high as $18,000. They can be $20,000 depending on the state that you're in and depending on how your loved one chooses to be buried. So when people think that the government is going to bury them, or that they have a plot that the government has given them, at the most, their spouse and dependent children are going to receive $985. That's not enough to bury anyone. That's not even enough to cremate anyone, right? And even though they may have that plot at the cemetery, it doesn't include the administrative cost that the funeral home is going to charge, or the professional services cost the funeral home is going to charge, which is about $2,100. It doesn't include the opening and closing of the grave if the plot's not open, right? If it's just a piece of dirt, or grass covered dirt, and it's not been dug to put the body in yet, there's a cost for that of anywhere from $1,800 to $2,500. So when people think the military is going to pay for their funeral, they're not going to pay for all of these services. And so we're going to talk about that in a different video of just a really incredible program that I was blessed to stumble upon and now add as one of the services that I can provide to my clients. But I just wanted to bust some myths for you, reference life insurance as it relates to term life and whole life. And then I want you to reach out to me. I've put in the description box my phone number and my website. So when you see the website, which is the funerallicenseadvantage.com, I think /Garlinda, you'll see it down there. When you click on it, you don't have to be just reaching out to me for Funeral Advantage insurance. That's just so you can complete the form. It'll send me an email and we can connect and schedule an appointment. Or you can call me or text me, 910-494-7798. But don't call me and just say, hey, I just want a quote. Right? When you call, I'm saying call me, but just know that we're not just going to do a quote, right? I'm an old-fashioned girl. I want to find out, what do you need for your family? What's going to make you feel secure when you go to the other side, to know that your family is taken care of? What do you need it for? What's your budget? How much do you need? Because if I just give you a price, but I don't know what your goal is or what you desire for your family, I'm doing you a disservice, okay? So again, it's Garlinda Price. I'm again, licensed life and health insurance broker. So if you already have life insurance, that's what I was going to tell you. We'll talk about that on a different video. If you already have life insurance, what we have is a special program for a special need that goes in addition to your life insurance that you already may have put in place, that is going to give money to your family within 24 hours of your death, put money in their hand. Because did you know that for some people that have insurance, it could take anywhere from 6 to 12 weeks for the carrier to pay out? It could take 6 to 12 months. When my brother passed away, we didn't know where his insurances were because we tried to find out before he died. This is back in January of 2023 this year. We didn't know where his policy was. We didn't know if he had a policy. And we had always been asking him, hey, we need to know what's up with your information, with your stuff, because he wasn't married and didn't have kids, but he didn't like people being in his business. Get in your family's business, right? So we had to wait on the death certificate before we could file the claim with his job to see if he had insurance through his job. Now, mind you, I sell insurance, right? So your family sometimes can be the toughest people. Well, come to find out, he actually did own insurance. He had actually gotten policies. My parents were the beneficiaries, but we didn't get the money to pay for his cremation or his memorial service from his insurance policies. That took 6 to 8 weeks. Right? So my parents were able to pay it out of my brother's checking account because my brother had savings account, because my brother had put my mom on his savings account. But if that hadn't have been there, we would have all had to put the money together collectively to pay for him to be cremated, right? Even though my parents probably could have paid it on their own as a sibling, right? You feel responsibility to help your parents in a time of grief. They're not even thinking straight, especially my mom, right? So don't let that be your story. And so if you already have insurance in place, great. Let that be the inheritance you leave your family. Let that money not go in the ground. We have a funeral program that we're going to talk about in a separate video. Again, we'll put money in your family's hand within 24 hours of your death, and then any other insurance that you have, that will start your legacy. Oh my God, they're going to talk so well of you when you die versus the people that have to do the GoFundMe, the fish fry, the bake sale, the cookie sale, whatever it is. They're asking people on social media to help put their loved one in the ground. That is not the legacy that we want to leave for people. Okay, I'm not dogging it out. I'm just saying that's not the legacy we want to leave behind because we don't have to. Okay, so again, Garlinda Price, 910-494-7798. And you'll see my website in the description box down below. God bless you guys. Talk to you soon.